Over the first half of 2018, the FOMC has continued to gradually reduce monetary policy accommodation. In other words, we've continued to dial back the extra boost that was needed to help the economy recover from the financial crisis and the Great Recession. Specifically, we raised the target range for the federal funds rate by a 1/4 percentage point at both our March and June meetings, bringing the target to its current range of 1 3/4 to 2%. In addition, last October, we started gradually reducing the Fed's holdings of Treasury and mortgage-backed securities, and that process has been running smoothly. Our policies reflect the strong performance of the economy and are intended to help make sure that this trend continues. The payment of interest on balances held by banks in their accounts at the Federal Reserve has played a key role in carrying out these policies, as the current monetary policy report explains. Payment of interest on these balances is our principal tool for keeping the federal funds rate in the FOMC's target range. This tool has made it possible for us to gradually return interest rates to a more normal level without disrupting financial markets and the economy. As I mentioned, after many years of running below our longer run objective of 2% inflation, inflation has recently moved close to that level. Our challenge will be to keep it there. Many factors affect inflation, some temporary and others longer lasting. So inflation will at times be above 2% and at times below. We say that the 2% objective is symmetric because the FOMC would be concerned if inflation were running persistently above or below our 2% objective. The unemployment rate is low and expected to fall further. Americans who want jobs have a good chance of finding them. Moreover, wages are growing a little faster than they did a few years ago. That said, they are still not rising as fast as in the years before the crisis. One explanation could be that productivity growth has been low in recent years. On a brighter note, moderate wage growth also tells us that the job market is not causing high inflation. With a strong job market, inflation close to our objective, and the risks to the outlook roughly balanced, the FOMC believes that, for now, the best way forward is to keep gradually raising the federal funds rate. We're aware that, on the one hand, raising interest rates too slowly may lead to high inflation or financial market excesses. On the other hand, if we raise rates too rapidly, the economy could weaken and inflation could run persistently below our objective. The committee will continue to weigh a wide range of relevant information when deciding what monetary policy will be appropriate. As always, our actions will depend on the economic outlook, which may and will change as we receive new data. For guideposts on appropriate policy, the FOMC routinely looks at a range of monetary policy rules that recommend a level for the federal funds rate based on the current rates of inflation and unemployment. The July Monetary Policy Report gives an update on monetary policy rules and their role in our policy discussions. I continue to find these rules helpful, although using them requires careful judgment. Thank you, and I will be happy to take your questions.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.